How to reduce inheritance tax. Data published by HM Revenue and Customs showed it received 7.5 billion in inheritance tax for the year March 2024. That is 400 million more than the same period last year. Official forecast suggests receipt could top up 9.5 million before the end of the decade. There are different ways to reduce your potential inheritance tax bill or avoid it completely. Number 1, giving asset to your spouse. Number 2, leaving your home to your children. Number 3, giving away money. Number 4, how the 7-year rule works. Number 5, how a life insurance policy can help. Number 6, passing on your pension. Inheritance tax can be a significant expense for many families. However, there are ways to reduce the amount you owe or avoid it altogether. Here are 6 strategies to consider. Number 1, giving asset to your spouse. One of the easiest ways to reduce your inheritance tax bill to give your asset to your spouse or civil partner. Transfer between spouse and civil partner are exempt from inheritance tax, regardless of the value of the assets. This means that you can pass on your entire estate to your spouse or civil partners without any inheritance tax being. Number 2, leaving your home to your children. If you leave your home to your children or grandchildren, you may be able to benefit from the residence nil rate band. The residence nil rate band is an additional inheritance tax allowance that applies to value of your home. For the 2023-24 tax year, residence nil rate band is £175,000. This means that in addition to the standard inheritance tax threshold of £325,000, you can pass on up to $500,000 your estate tax-free. You can reduce the value of your estate by giving away money during your lifetime. Each tax year, you can give away up to £3,000 without it being included in your estate for inheritance tax purpose. This is known as annual exemption. You can also give away up to £250 to any number of individuals each tax year, as long as they have not benefited from your annual exemption. Additionally, you can make gift out of your income as long as they do not affect your standard of living. How the 7-year rule works. Gift that you make during your lifetime may be subject to inheritance tax if you die within 7 years of making them. However, if you survive for more than 7 years after making a gift, it will be exempt from inheritance tax. This is known as the 7-year rule. If you die within 7 years of making a gift, it may be subject to inheritance tax on a sliding scale, known as taper relief. The amount of tax due will depend on how many years you have passed since the gift was made. How a life insurance policy can help. Take out a life insurance policy can help cover the cost of any inheritance tax that may be due on your estate. By writing the policy in trust, the proceeds of the policy will be paid out to your beneficiaries tax-free and will not form part of your estate for inheritance tax purpose. This can provide your loved ones with a lump sum to pay any inheritance tax due without having to sell asset or dip into savings. Passing on your pension. Pension are generally not subject to inheritance tax, so passing on your pension to your beneficiaries can be a tax-efficient way to reduce the value of your estate. If you die before the age of 75, your pension can be passed on tax-free. If you die after the age of 75, your beneficiaries will pay income tax on any withdrawal they make from the pension at their marginal rate. By naming your beneficiaries on your pension plan, you can ensure that your pension is passed on to the people you want to benefit from it. By considering these strategies, you can potentially reduce your inheritance tax bill and ensure that more of your wealth is passed on to your loved ones.